You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, so if we look at last week's trade, we went into a extensive discussion on what a skip strike butterfly is and how interesting a skip strike butterfly may be in this type of environment. With the implied volatility index, actually as of today, it's still up over 30% implied volatility. And once again, I should probably mention, we are taping Options Playbook Radio on March 4th. The markets are closed at this point in time. Market did have a very solid rally today going into the close, especially. The S&P 500 index closed at 3,130.40. It was up over 127 points on the day. And the VIX index is still quite elevated even after that big move. We had the VIX index that closed approximately at about 32% implied volatility. And it makes it very interesting when you're talking about S&P 500 index option contracts to do skip strike butterflies, et cetera, in that you have a very expensive underlying that adds premium to the option contract, and then you have the fact that the implied volatility is extremely high in the VIX, which correlates to the S&P 500 index options, and it just makes an interesting environment to do things like skip strike butterflies. Great discussion last week on it. Now we're going to go into a new trade for this week, and before I forget, I'm going to let you know that on March 11th, which is a Wednesday, Ally Invest is going to be having its first digital conference. It's called the FOMO Free Financial Future Digital Conference. So it's going to be our first conference that we did 100% online. You'll be able to watch it via YouTube, and you can actually register for it by going to ally.com/FOMO free, and that's FOMO free. So FOMO stands for fear of missing out. It's a millennial type term, I guess, in this day and age, or you could say a text term or something like that. But fear of missing out. And I think that a lot of people right now, looking at the markets and looking at the big upturn that we just had, are wondering, when should I jump back in? As far as the markets are concerned, we're down about 8% from its high before the big downturn. And I'm going to look at a trade that I'm going to call the FOMO, fear of missing out, long SPY call spread. So if you've already panicked and you've already sold and already got out of the marketplace, or you just happen to have some cash on the sideline and you're waiting and you say, well, gee, if the market would just get back to where it was, I wouldn't mind getting back in, but I also don't want to lose the upside if that happens. So what's a trade that we can do? And a lot of people, when they think of options, they just think of speculation. They don't think of what options were first intended to do to protect assets, to protect underlyings against a downward movement in the marketplace. And so your mind goes to how can I speculate and leverage using options as opposed to how can I protect. And in many ways, a lot of people think of puts as protection, but call options also can be used as protections. For example, if I buy a call option, that synthetically looks exactly like buying the stock and buying a protected put. Now, if you ask two people, what is your outlook if I buy a long call, same strike as the put, by the way, and I buy the stock and a put option, and I say, well, what is your outlook for each of these strategies? One of them, most people would say I'm bullish, the long call, and a lot of people would look at the protected put and say, well, that's a bearish trade. Well, they're both bullish because both of them you want the marketplace to go up. So we're going to kind of use that theme, and we're going to use the theme of our first digital conference, FOMO, fear of missing out, and we're going to look at a long call spread or a bull call spread in the SPY. Now, the SPY index doesn't exactly match the S&P 500 index, right? The SPY is the ETF based off of that index, and it trades for 1/10 of the value of the S&P 500 index. Fairly close. It's not exactly, but about 1/10 of the value. So that means that the SPY, based off of the market close, was actually at $312.86 to be exact. That's where the close was at. So we're going to look at using the SPY as a fear of missing out trade. So we're going to try to take the time premium out of the option contracts. And so we're going to go in the money on the long call, and we're going to go out of the money on the short call. And our whole goal here is to buy about the same amount of time premium as we are selling. So we're just going to be between the strikes. If we put this position on, we're going to play. So if the market goes up to the strike that we sold, well, that's good news. That's good news. That's going to allow us to participate in the move up. But now if the market goes down and it goes below the strike that we're buying, well, we're going to take our ball and we're going to go home and we're not going to play anymore. So we're only going to participate in between the strikes. And when we do this trade, we're not going to have any time premium. We're going to buy the same amount of time premium as we're selling. So this is just an interesting alternative. If you're just sitting around, you're saying, well, there's no way that I can pick the bottom. There's no way that I can pick the top. In the last couple of weeks, we've had a 1,000-point run-up in the Dow, and then we had a 1,000-point drop, then a couple 1,000-point return, yada, 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 but extreme volatility over the last 2 weeks of trading. So our fear of missing out trade, and I'll just get right to it, is, well, if we can get to the summer months and we can kind of protect ourselves against an upward movement in the marketplace, along with we want to protect ourselves against a giant downward move in the marketplace, this is the trade that we're going to look at. So we're going to use the monthly option contracts that expire in July. That expiration date is July 17th of 2020. And we're going to go deep in the money. Remember, the market's at 312.86, up a big amount today. And we're going to buy the 290 strike call. Now, remember, I mentioned that the VIX is up over 30, and that is a big issue here because option contracts get expensive when people are scared, and this is definitely the case. If we look at that option contract with the market at 312.86, we're $22.86 in the money, $22.86 in the money. But this option contract, and I'm just going to round off to the midpoint approximately, is around $31. So even though we're going fairly deep in the money, there's still a lot of time premium. But then again, we are going out to July 17th. So just in general, there's going to be a lot of time premium in the option contracts overall. But a lot of this premium is actually implied volatility premium. So 135 days to expiration. We are going to buy a few of these. You're going to have to judge based off of your portfolio or your cash position how much you'd be willing to risk, because it's not going to be a riskless trade. We're just going to we're not going to go all in, and we're not going to just buy the SPY because we're trying to get the timing right. What we're doing here is we're just exactly fear of missing out. We're worried that the market might bounce back and we don't participate in any of those gains. And we're also worried about the fact that the market could tank and could go down another a couple thousand points in the Dow Jones Industrial Average or a couple hundred points in the S&P 500 index. So that's our fears, and this is how we're going to try to address them. So if we look at that trade, now I went and I did the time value in that option contract. As I mentioned, the market in the SPY is 312.86. We're at the 290 strike call. We're about $31 is about the midpoint. If I do the actual time premium here, that option, if we buy it, has about $8.22 worth of time value in it. So now that we know that, we're not going to base the strike on our forecast. The market in the SPY started to, the high point of this year before the market actually started to tank was right around 340 in the marketplace. So we're going to try to get somewhere close to that. But I'm more worried about the time premium. So what I actually did was went out and said, okay, $8.22, what option contract can I sell that will bring in approximately that amount? And in this instance, I looked at the 326 strike. That option contract with the markets closed right now is 790 by 820. So it's not quite $8.22, but we'll call the midpoint in this instance, we'll call it $8 just to make life simple. So if I'm looking to do this trade, now between the strike prices, that's the only place that matters to us. If the market goes up above 326, that's great. We didn't miss out. We were able to partake in the move to the upside. If the market goes down below 290 and continues on down to 270, 260, 250, that's okay. We knew we had some risk here, but our risk ended when the market got below 290. Now, we can do this entire trade approximately at the midpoint. Now, the markets are close, so I'm just going to use approximations, and midpoint fills aren't guaranteed, at $23. So $23 means that for every 1-by-1 spread, you're going to invest $2,300 plus commission to put on that position. So that's going to be your maximum risk on the trade. Now, there is a little bit of a skewing going on in the marketplace because, as I mentioned, the VIX is up above 30, so the fear factor is in, and implied volatilities are increased usually on the put side as opposed to the call side, but $2,300. Now, that's for every 1-by-1 spread that I do. That is also going to be the maximum that I can lose on this trade. And if the market just stays where it's at and it doesn't move at all, I'm basically going to be on break even. So if I put this trade on and on July 17th, I come back and I look at the market and I say, wow, the market's still at 312, I'm going to be at break even on the trade. So that's my goal here, is to try to get myself in a position where I have limited and known downside risk, but I still can partake if we get a move back to the all-time highs in the SPY and SPX index. Okay, so now my total risk is at $23. What is my upside on this trade? Well, to figure out the upside, you take 326 minus 290, and that gives you the width of the spread. that's $36. All right, so that's the maximum that this can trade for, is $36, the width between the strikes. That means that if we pay $23 for this trade, our total risk to the downside is going to be $23, and our total benefit to the upside would be $13 on this trade. So because of the environment of the marketplace, we don't quite get the same amount of upside as we do on the downside. But that's what you have to pay for when you're trading in a volatile marketplace. So, to recap, we're looking at a July 17th expiration. We're going to go on out to summer. We're hoping that the marketplace will settle down, that the fears of the coronavirus will be subsided a little bit, but we're a little scared about what's going on in the marketplace, so we're going to do a limited risk trade that will give us some upside if all the fears come in and the market and economies still are rocking and rolling, and we are going up back towards the highs of this year in the SPY and the SPX, and also have limited and known risk on the downside. We're going to limit our risk below the 290 level in the SPY, and that also means our net debit is going to be our total risk on this trade, and that total net debit is $23 approximately, or $2,300 for every 1-by-1 spread that we put on. The maximum upside is going to be that $13 if the market is above 326 by that July expiration date. But now we can just put this trade on, and as long as we manage our risk and we think about our ratios, about how many of these we'd want to put on to kind of protect ourselves against an upward movement in the marketplace, because that's really what we're trying to do here. We're trying to, we don't want to miss out on a big move after a big downturn. And maybe we're out, maybe we're in cash, but this is one way that we can play it. So I'm going to build this as the fear of missing out long call spread in the SPY, and that's going to lead us right into our first digital conference at Ally Invest, which is going to be on March 11th, a Wednesday. It's free for everybody. It is the FOMO Free Financial Future. It starts at 9 o'clock. You can register at ally.com/FOMO free. You can see the agenda and see all the different speakers that we have from the industry. We have people talking that represent some of the ETFs that are available within Ally Invest. Myself will be talking about covered call writing, just a plethora of different speakers across the board. So please check it out. And I guess that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.